Welcome back. We are now in segment 6.17. This is the last segment in our chapter 6. So in this segment we will do a small exercise to see how well you have understood the concepts under the of the assets, right? Earlier we have done a couple of exercises on liability side. One exercise on capital and reserves and surplus, and one more segment on the remaining liabilities. In this exercise we will take we'll review questions related to all the assets item. So the first question is, the ideal level of cash holding for companies to maintain is 10 lakhs. True or false? Well, this is an easy one. So we already discussed this under the segment of cash and bank balance. So there is no hard rule. Now what is the ideal cash to be maintained? It varies from industry to industry. We discussed the example of a supermarket. A supermarket like say Spencer. This is a business that deals with a lot of cash. Now there will be a lot of cash sales, and the business at any point of time will be having a lot of cash. Whereas we also discussed the example of equipment manufacturer, or a company which is into manufacture of these equipments, heavy vessels, and that sort of a company will be having very little cash transactions, and there is no need to hold a lot of cash, right? Because it deals mainly both on the sales side and on the purchaser side. It deals with very little cash. So yes, the answer to this question is false, right? There is absolutely no clear answer for this, right? What is the ideal level of cash holding actually depends from the varies from industry to industry. Maybe if you want to have a more reasonable picture, you should compare, right? You have to compare companies operating in the same industry, right? You have to compare various companies operating in a similar industry, but also not just the same industry, but also of approximately same size, right? What do you mean by same industry? Two companies which are competing in the same market, right? In the same who are targeting the same customers, right? For example, Coca-Cola and Pepsi, right? Coca-Cola and Pepsi are two companies, right? You can call them in the same industry, and they're also same size. We can compare them between same size, but you can't compare. But then you can't compare your customer who has a annual turnover of say 1 crore, right? Say for example he's a small time steel trader. You can't compare this with another steel trader who maybe the activity is same. He's also a steel trader, but who's having a turnover 100 crores. This comparison you can't make. So when we say peer comparison, you know what do you mean by peer comparison? Peer comparison means companies operating in the same industry, but also around the same size, right? So in your banking industry, for example, we can compare banks like Bank of Baroda and Bank of India, right? PNB, Canara Bank. These are banks of a larger size. You can compare them. Now, if you want to compare the financial parameters, if you want to compare the advances growth, if you want to compare the net interest margin, now various parameters you can compare on this group. But you can't compare a corporation bank like or a Vijaya Bank, right, or Bank of Maharashtra, right, or Andhra Bank. I mean, these are of a different size. So even though they're operating in the same industry, you can't compare them. So whenever we say peer group comparison, we mean that companies operating in the same industry and also roughly of the same size. So if you want to know what is the ideal cash holding, maybe a better way is to look at the other companies operating in the same industry, right, as the applicant company, and then maybe of the similar size, roughly of the same size, and see what is the average holding level for these companies, and then you can come to an assessment whether the cash holding maintained by this company is high or low, right? So the second question is, a company is applying for enhancement of OCC limit from 8 crores to 10 crores. The company is generating very high profits and has therefore projected cash and bank balance at 3 crores. This is the cash and bank balance projected, right, for the next 2 years. So comment on the projection submitted by the company. This is something which we already discussed on the cash and bank balance. So what we said that you should be very careful about the cash level projected by the company. The projected cash level should not be so high. Against the enhanced limit of 10 crores, the company is planning to maintain a cash margin of cash and bank balance of 3 crores. So this is something which we already discussed. We're not going to repeat it here. Please refer to the section on cash and bank balance. This is something which cannot be accepted. So briefly, though I'm not going to elaborate on this, very briefly. So what the company is actually saying is, this is the projected figure, right? So let us say this is 31/3/2015, right? So what the company is saying, as on that date, our OCC balance will be 10 crores. Our current account, right? This cash balance, let us say it is in the current account, it is 3 crores. So this is not a situation that is going to happen, because if you are a promoter of this company, think of yourself as the owner of this company. You are not going to allow this to happen, because on one hand you are having an OCC outstanding of 10 crores, you are paying an interest on this, say 15%. On the other hand, you are having a cash balance, ideal cash balance of 3 crores in the current account, which is not paying you anything. It is a zero interest, right? This is zero interest. So you will not allow this to happen. If you are the promoter of the company, what you will do? You will immediately transfer the 3 crores from the current account to the, bring down this outstanding of OCC to 7 crores. Then the OCC will be 7 crores and the cash bank balance will be 0. Keep you always keep a very minimal cash balance, because idle cash is not going to earn anything, right? So here this is a very unlikely scenario where you have a 10 crores OCC outstanding, and you're paying an interest of 15% on it, whereas you're having idle cash balance of 3 crores. So this is a situation that's not going to arise. So what we also discussed, why this situation arises. So when companies or their credit consultants prepare the CMA data, when they arrive at a very high profit figure, and the profit figure is very high, so they have to put it somewhere, right? So we discussed on the asset side, we can't have, they cannot inflate the inventory figure very much, because bank will question the holding levels. We'll discuss holding levels later. They cannot have a very high debtors level. So what usually do, they put that amount in the cash or other current assets. So whenever you see figures very high on in the cash and other current assets, you have to question them. This is irrespective of the argument of the company that the company is making very high profits. This is not acceptable. If really such is the situation, if the company really believes in these projections, the OCC requirement will be only 7 crores. If the company really believes it's going to generate so much profits and is going to have a cash balance of 3 crores, then definitely you have to, the company will be sufficiently, the company can manage with a working capital limit of 7 crores, right? So this is not a situation we are going to accept. Maybe the company has to submit revised projection. So look at the third question. A company is holding 10,000 shares of Reliance Industries. How should we classify this in CMA? Current asset, because they can be sold in the secondary market and cash realized quickly. Non-current asset, because you cannot tell for certain whether the stock market will be favorable or not tomorrow. Intangible assets, because the shares are not in a physical form but only in demat form. This is a easy question. So quoted investment, this is what we call quoted investment. The company has invested some of its cash in the share market, right? These are investment, but then it is a quoted investment in the sense that they are listed in the stock exchange and they can be sold at any point of time. This is the first answer is correct. This is a current asset. See, the question, one of the options is this is a non-current asset, because we cannot tell for certain whether the stock market will be favorable or not tomorrow. So say for example, the company is holding total 10 crores. These shares are worth 10 crores. The company is holding Reliance shares worth 10 crores. So what the second option is saying is, we don't know if we sell this, since we bought them at 10 crores, we don't know what the shares will fetch us. Maybe tomorrow they'll fetch us only 9 crores or 8 crores, 7 crores. We don't know, because we are not certain. Because we are not certain whether the stock market will be favorable around tomorrow. We don't know what is the price we are going to get tomorrow. Because of the uncertainty, we have to classify it as non-current asset. But that is a wrong option. You see, we are not speaking about the value here. We are speaking about the quickness. We want a simplified term. It is the quickness in which the asset can be converted into cash. So these quoted investments are something that can be converted into cash very quickly. The loss in value is something a different issue, but this can be converted into cash very quickly. So this is a current asset. So this can't be a option. Third option is intangible asset, because shares are not in physical form but only demat form. Even if it is in demat form, that doesn't make it a intangible asset. Intangible assets are something different, right? We discussed about them. So this is the correct option is the first option. So the fourth question is, debtors figure appearing in the balance sheet as on 31/3/2014 is 50 lakhs. So debtors figure is 40 lakhs, 50 lakhs. There are no other item in the balance sheet relating to debtors. Okay. The credit period offered by the company to its customers is 3 months, right? This is the credit period offered by the company. Now, which of the following is true? Credit sales of Jan, Feb and March put together is 50 lakhs. So this is the position as on 31/3/2014. As on 31/3/2014, the balance sheet figure under debtors is reading 50 lakhs. So one of the options is asking, the credit sales of Jan, Feb, put together, the credit sales is 50 lakhs. Is this an option? Or out of the total sales made in 2013-14, this financial year 2013-14, an amount of 50 lakhs is yet to be received. The third option is, you cannot tell in which year or month these sales were made. So see here, as on 31/3/2014, the debtors figure appearing in the balance sheet is 50 lakhs. So how are we to interpret this? So one of the options is asking, the sales made in Jan, Feb, March put together is 50 lakhs. That is the previous three months. This is March, the month ending March 31st. So the prior 3 months are Jan, Feb, March. These are the 3 months. And since the credit period offered by the company is 3 months, so the question is asking, the latest 3 months sales, as on this data, Jan, Feb, March. So these 3 sales are reflecting here, because the credit period is, we are saying that the credit period is months. Since the credit period is 3 months, the assumption here is, what the question is asking is, the sales made in December must have been realized. You must have realized cash for December, November, and all prior months. All prior months you have realized cash. That is the assumption. Because why? Because say for example the sale made in November, since you are offering 3 months credit, you must have received it by December, Jan, and Feb. So this is realized in Feb. December, the sales made in December must have been realized in February. Must have been realized in March, because you have given in 3 months credit. The sales made in Jan, right? Sales made in Jan you will realize sometime in April. Sales made in Feb you will realize in May, and the sales made in March you will realize in June, right? So for these 3 months, the question is saying, the first option is saying you didn't receive cash. For the remaining periods you received cash, so they won't appear as debtors because you already received cash. But whereas for these 3 months you didn't receive cash, so they are reflecting as debtors. So is it a correct argument? Well, it is not a correct argument. So this is one of the common pitfalls into which you might fall into when dealing with debtors. Please understand the concept of debtors very clearly. Debtors, we are not saying is the recent month, right? See, so what we are actually saying here is, out of the sales made till, see this, till 31/3/2014, we are yet to receive an amount of 50 lakhs is pending. We are saying 50 lakhs is pending out of the sales made till 31/3/2014 from the inception of the company. We are not speaking of the previous 3 months. Please make sure you understand this concept very clearly. See here, it is true that the sales made in November you have given 3 months credit. So actually they should pay by February, but it is entirely possible that some of them didn't pay. So it is possible that as on March 31, 2014, still the sales made in November, still 10 lakhs is pending. It is very much possible. It is not that everybody who bought from us from November has paid. Yes, we gave them 3 months, but they failed to pay by March. So they are still a pending customer. So they will appear as debtor in the balance sheet as on 31/2014. Similarly, some 5 lakhs sales made in December, they are yet to pay. Maybe another 5 lakhs in Jan, another 10 lakhs in Feb, right? Another 5 lakhs in March. How much is the total? 15, 20, 25, 35. So 15 lakhs may be pertaining to a sale made somewhere in, say, December 2000. Well, this is not even in this financial year. Like these sales are made in financial year 2013-14. This sale is pertaining to, this 15 lakhs is pertaining to financial year 2012-13, right? So it is entirely possible that the 50 lakhs data which you are speaking pertains to sales made in the last month or last 6 months or last 1 year, 2 years, we don't know. These are the sales pending payment to be received from the customers out of the sales made till 31/3/2014, irrespective of the period. So this is not the sales of the, this is not the pending payment for the last 3 months. This will go to a very long period back, right? So we don't know what this is. So the correct option here is the third option. We cannot tell in which year or month these sales were made. First of all, this doesn't pertain to the last 3 months. We don't know. The second option seems to be more reasonable. Out of the sales, total sales made in financial year 2013-14, an amount of 50 lakhs is yet to be received. But it can be possible that even the sales pertaining to 2012-13, some of them is yet to be received. Maybe some 20 lakhs of this year and 30 lakhs of this year is pending. Out of the 50 lakhs, we don't know. So the breakup is something which we cannot say from the balance sheet, right? We need additional information if you want to exactly know the breakup. So the correct option is the option. So the next question, under debtors in the balance sheet, the following entry is made. Debtors 100 lakhs, less provision for doubtful debts 5 lakhs, and the net figure is 95 lakhs. So where are the above 3 figures to be placed in the same data? Where are you going to place this 100 lakhs? Where will this 5 lakhs go and where will this 95 lakhs go? Might be a bit tricky for you. Actually, only one figure goes to the CMA. So we don't enter 100, we don't enter 5. See, this 5 is actually already entered in the P&L account. See, we debited the P&L account by we debited the P&L account by saying we created an item called provision for doubtful debts. So this figure is already accounted for. This provision is already made. You have burdened the P&L account by 5 lakhs. You have reduced the profit by 5 lakhs. You already made a provision. So this 5 lakhs is not going to come in the balance sheet. Balance sheet, the figure which you are going to take is only 95 lakhs. In the CMA data, the data you are going to take only 95 lakhs. You're not going to take 100. This 5 is already reflected. You're going to take only 95 lakhs. So in the CMA data, if you want to fill that row pertaining to data, you have to mention only 95 lakhs. You're not concerned about the provision. That is already met, right? That is already met in the P&L account, right? So next question is, the debtors figure appearing in balance sheet is 22.5 crores. The notes to account states as follows. A court case is pending with respect to dues from a customer amounting 3.7 crores. The debtors amounting to 22.5 crores. This 22.5 includes this amount of 3.7 crores for which a court case is pending. The case is pending for 4 years. However, a favorable decision is expected within the next 12 months. How do you treat this debtors amount of 22.5 lakhs in the CMA data? 22.5, right? Out of this 3.7 is something, is the data that is very old. That is 4 years back. We made a sale to a customer, but he didn't pay up, and there is some court case in progress, right? And the balance, let us say it is all the good debts. The balance is 18.8, right? This 18.8, let us say all are the good debts, right? So put together 22.5. So how are we going to classify this in the CMA data? So in the CMA data, we have a item called debtors and another asset side, right? We have a item called debtors. So where, so what figure are we going to keep here, right? That is the question. So please note that we are going to have only 18.8 crores. This figure only is here. So this 3.7 crores we are going to classify it under non-current asset. This data appears under the current asset. Right? In current asset will show only the 18 point, because which are reasonably certain that we are going to recover in the next 12 months. So that's why it's a current asset. An asset, current asset is a asset that can be converted into cash within the next 12 months. We are reasonably certain. So these data are all right. I mean, in the sense that we are reasonably confident that we can get back our juice within the next 12 months. But this is something doubtful. See, the case is already pending for 4 years. So even though the question says a favorable decision is expected at 12 months, it might happen or might not happen. This is not something which we are going to rely on. If the notes to account actually have this statement as it is, we are not going to. It's not that we are not going to believe it. See, it's not that we are not saying that the court case will never come in favor of the company. Yes, it might come, and the company might recover this 3.7 crores. So, but even then, we are not going to classify it as a current asset. This you have to classify as a non-current asset, in the sense that we are not certain. You see, for the last 4 years, the amount is pending for us. We are not received. So, what is the guarantee we are going to receive? So, unless you are very confident, that and significant progress has been made with regard to the court case, and you are very confident of receiving it, unless you are very certain of it, better to classify it as a non-current asset. Actually, when the company prepares the CMA data, please note that when the company actually submits the CMA data, then we are checking it, or then we are actually preparing a new CMA data. So we are not accepting the classifications as it is by the company. We are preparing a CMA data on your own. In the version of the CMA data prepared by the company might actually classify this entire amount as a current asset. The logic of the company is this 3.7 crores is something that's going to be realized within the next 12 months. That is the logic of the company. The company can do that. The company can classify it as a current asset in its CMA data. But when it comes to you as a banker, when you start analyzing the CMA data, you have to make this modification. You have to take this 3.7 out and classify it as a current asset. Next question is, a rice mill has some paddy stock in its godown. The cost at which the firm purchased this paddy is 25 lakhs. The cost, right? The cost at which the paddy was purchased is 25 lakhs. However, as on date of the balance sheet, the market value of the paddy has decreased. And if the firm were to sell the paddy in the godown today, right? The paddy in the godown, if it is sold in the market today, it will fetch only 21 lakhs. So this is the sale realization. So the realizable value is 21 lakhs. So the question is, what is the value of the paddy to be shown in the balance sheet? So to raise the balance sheet, you have to record the inventory. So today is 31st March, and you have to show an inventory figure. Which figure are you going to show? Are you going to show 25 lakhs or 21 lakhs? So please refer back to a discussion where we discussed the inventory. In the segment under inventory, we spoke about this topic, right? What we said, the balance sheet inventory value should always be the lower of 1, the cost, and 2, the realizable value. Out of these two, whichever is the lower, you show it. So since 21 lakhs is lower, you have to show 21 lakhs, right? The next question is, will your answer change if the rate of paddy increase to 32 lakhs? I mean, if you sell in the market today, you're going to get 32 lakhs. So will your answer change? So cost is now 25 lakhs. Cost is same 25 lakhs. The sale, the realizable value, you're going to get 32 lakhs. So in the balance sheet, are you going to show 32 lakhs just because the rate has increased? No. You're still going to show, you're going to show only 25 lakhs, because the lower of cost or realizable value. In this case, the cost is 25, realizable is 32. Still the lower is 25. Earlier case, the value, this was lower, this was 21. Then we took this, because which is the lower we'll take, right? We are applying the principle of conservatism here. We're trying to be conservative in the valuation of this inventory. So even though the sale might fetch 32 lakhs today, we are saying we'll put only the cost 25 lakhs, right? So the answer to this question is as it will change, and we are going to show 25 lakhs only, right? So the next question is, a supplier can be either a raw material supplier or a supplier of capital goods such as machinery. Advance paid to suppliers is to be classified as a current asset in the GMA data. So advance paid to suppliers, right? Advance paid to suppliers. So here the suppliers can be raw material supplier or a machinery, capital good supplier. Capital good like machinery, equipment, any capital good supplier. So the question is saying that this advance paid to supplier should be classified as a current asset in the same way whether it's true or false. Well, not all advance paid to supplier is a current asset. So this is broken down into raw material and machinery. So the raw material suppliers you can classify it as a current asset, whereas the advance paid to supplier of capital goods you're going to classify it as a non-current asset. So the answer is false. Why are you going to classify it as a non-current asset? Tomorrow, in the next balance sheet date, this non-current asset, this machinery is going to be converted into fixed asset. It's not going to move into current asset. This is different. The raw material, the advance which you pay to raw material suppliers, you're going to get material, you're going to get stock out of the advance paid, and some other balance of money which you pay, you get the material. That raw material is a current asset. So that is different. This current asset is going to be converted. This advance paid to supplier current asset is going to be converted into another current asset called raw material. But this is different. If you classify this as a current asset, you're saying an item which is now in the form of current asset is going to be converted into fixed asset later. That is not acceptable. So this you have to classify as a non-current asset. So this is a non-current asset. So the answer is false. Next question is, insurance paid for inflammable stock is an example of current asset, prepaid expense, both the above, none of the above. So insurance paid, we already discussed, right? Insurance paid, what are you saying? So let us say the insurance policy has lapsed as on 31/3/2014. It has lapsed. So now you have to renew the policy. Now you have renewed the policy, and starting from 1/4/2014 to 31/3/2015, the policy is valid. So something happens during this period, you're going to be reimbursed for the loss, right? Loss of the whatever loss you're going to incur. So please note that the payment is already made because you have renewed the policy as on this day. The payment is already payment is made, but the service is not yet availed. When are you going to avail the service? In the next year, from this period 1/4/2014 to 31/3/2015. So as on this date, as on this balance sheet date, the payment is made but service is not yet availed. So this is a asset. See, tomorrow if something happens to the machine, even though you don't pay the amount, you're going to be getting the service. That machinery, the loss which you incur is going to be reimbursed to you without you having to pay anything because you already made the payment last year. So this is a current asset. One, it is a current asset, and also it is a prepaid expense. Both, right? One, it is a prepaid expense. Under current assets, you have many classifications. Inventory, right? Debtors, various items. Yeah, one item is prepaid expense. Prepaid expense is one of the current assets. So what is this? This is both a prepaid expense. So also in the broad sense, it is a current asset. This is a broad sense. This is a specific example. This is a specific description of this particular item. So it is both so correct answer is both current asset and prepaid expense. So next question is, a promoter is also managing director in one company XYZ. Just like any other employee in the company, he is also an employee. Well, there is no also here. The promoter is a managing director in a company called XYZ. So just like any other employee in the company, he is also an employee. The only difference being his designation and salary. So there is a worker here and there is a managing director. So both are employees, right? Both are employees, only that he is earning more salary. Maybe he's got more powers. Designation is different. So now the company has given advance to both a worker and the director. The company has given a advance. So the worker has given some salary advance, and here also it is given some advance. The question asks, how are these to be classified in the same way? So both are current assets, both are non-current assets. Advance salary to worker is a current asset, while loan to director is a non-current asset, or the other way around. So this is something which we discussed earlier, right? Another item of advance is recoverable in cash or kind. This we discussed. Now also under non-current assets, if you remember, dues from director, there also we discussed. The salary advance to workers is also always classified as a current asset, whereas advances, loans to directors, partners, those are classified as non-current asset. So this is something which we discussed. So this is third option is the correct option, right? Next question. A new factory building block is under construction. The company is charging rate of depreciation of 15% on completed buildings. What is the rate of depreciation to be charged on the block under construction? So is this 15%? 50% of that 15%, that's 7.5%. Depends on how much work is completed. For example, if 25% is completed, we have to charge 25% of that 15% because we are charging 15% on the completed buildings. And since only 25% is completed, we have to charge 25% of 15%. That is 3.75% or 0%. Again, this is a concept which we discussed under fixed assets. While discussing fixed assets, we discussed there in the segment that what is this? This is work in progress, under construction, work in progress, right? We are not going to charge depreciation on work in progress. Please note that depreciation is only on the completed assets. This is a work in progress, so here we are not going to charge any depreciation. So what is the depreciation to be charged? 0%. So next question is, as per revised schedule 6 of the Companies Act, the debit balance in P&L account, that is the accumulated losses, is to be shown on the liability side as a negative figure under reserves and surplus, or on the asset side as a positive figure under intangible assets. So again, we discussed this earlier. Earlier we used to show like this, right? On the asset side, we used to show it as the intangible assets. But as per the revised schedule 6, right, now we have to show on the liability side as a negative figure under the reserves and surplus. So starting from 2011, April 2011, all companies are going to prepare the balance sheets as per this revised schedule 6. So now if the reserves and surplus is a negative figure, you're going to show it. So capital is 100, then reserves and surplus maybe say minus 60. You're going to show it as minus 60, and then have the net worth will be 40. Earlier what you used to do, paid up capital you used to show 100, reserves and surplus you're not going to show dash, and then on the liability, on the asset side, under accumulated losses, you're going to show a positive figure what's called 60. Net effect is 40. Net effect is still 40, 100 minus 60, but now you have to show here itself under the capital, show the reserves and surplus as a negative 60 and arrive at a net worth of 40, right? So the correct option is first option. So let us see the last question. The net fixed assets of the company as on 31/3/2014 is 75.18 crores, right? One of the statements on the notes to accounts mentions that the defuming machine of the acid plant has become obsolete and it's not being used by the company in its operations. The company plans to sell this machine, whose WDV is 2.77 crores. The buyer is already identified and sale is likely to materialize during June 2014. That is just 3 months from now. 3 months from this balance sheet date, the sale is about to happen. So how are you going to treat the net fixed asset figure of 75.18 crore in the CMA? So 75.18 is the fixed asset, the net fixed assets appearing in the balance sheet. So this includes some 2.77 of some machinery. This planned to be sold, and the balance is going to continue. So this 2.77 you have already identified. One you have planned to sell, not just plan, you have already identified the buyer. So within 3 months, that is by June 2014, this machine is going to be sold and is going to be off from your balance sheet. So how are you going to classify this? So this is a concept we also discussed earlier. One, we are not going to show it as a fixed asset because it's not going to be a fixed asset anymore. In the next balance sheet, the balance sheet is not going to be a fixed asset. So let us not show this 2.77 as a fixed asset. So you have to show it as a non-current asset. If you remember this we discussed under the concept of asset held for sale. So there we discussed this. So this is a non-current asset. Okay. So with this we come to the end of the segment. In fact, we come to the end of this chapter. So in this chapter we have discussed various items that can appear in a balance sheet of a company. So in the last two chapters, that is chapter 5 and chapter 6, we have completed discussion of all items that can possibly appear in the P&L account, profit and loss account, and balance sheet of companies, right? So with that we have the basic knowledge to proceed further. The logical step next would be normally would have been ratio analysis, because once you discussed all the items, maybe ratio analysis would have been a better topic. But then from a banker perspective, right, since you are into the domain of banking, it's better to understand, it's better to complete two other very important topics. One is the term loan appraisal, and other is the working capital assessment. So these two, once you complete these two, and then we will go on to ratio analysis. So this flow will give us a better idea to appreciate ratio analysis, because here there are many items which you need to consider. For example, when you say term loan, say for example margin, right, term loan margin, whether the capital which the company has envisaged, whether it has come in or not. So unless you understand that term, you cannot analyze the relevant ratios, right? Ratio analysis, we have an item called current ratio, a very important ratio. But unless you know working capital assessment, what is the need for this working capital margin, right? What do you mean by net working capital? So unless you understand these terms, this will be very difficult to appreciate. Simply we cannot go and calculate. We can still mathematically calculate this, right? Usually in textbooks, this is a stage where they introduce ratio analysis, but we are discussing these two chapters in advance, because this will help you in appreciating the ratio analysis, this will help you to interpret the ratios more correctly, right? So in the next chapter, that is chapter 7, we'll start term loan appraisal, and the next chapter 8, will be taking up working capital assessment. So from then on, we can go on to we can go on to ratio analysis later, right? So see you in chapter 7.